Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Last video we looked at Kevin O'Leary's dividend paying stocks. We picked 10 stocks out of the list of companies that he owns in his portfolio, which are very long because he has his own ETFs. He's got so many great companies in his portfolio. We looked at 10 and we picked and talked about it like in the last video. In today's video, I'm going to talk about the growth side of it, the companies that are still growth oriented companies that do not pay any dividends. Some of these companies are still in the growth stage, so some of them might have earnings, some of them might not have any earnings, and that's what we're going to talk about. As you can see, the portfolio is down a little bit today, but as you can see, overall yesterday in the stock market, it was kind of okay day. It wasn't bad considering the Fed came out in the US and it raised the interest rates as expected. Yeah, it was kind of okay day. So I'm going to talk about the UK and the US interest rates in another video, but I'm just going to get to what we need to do today, and that's to look at those 6 different companies that Kevin O'Leary owns in his portfolio. But before I do that, if you are new to the channel, please subscribe to the channel. Give the videos a like. It really genuinely helps. The more people that can see the videos, the better for the community and for all of us, inshallah. And like I've always said to you guys, if you are new to the channel, come, welcome, and yeah, join the community hopefully, and let me know if you have any specific questions. Some of you are now very new to investing, so I'm gonna do a couple of videos to kind of get you started, inshallah, in the next few weeks, because you've asked me a few questions on either Instagram or here. So I'm gonna try to put something together, inshallah, for any brothers and sisters that are new to investing, especially in the stock market. Right, so let's look at these 5 companies. Before we do the look at them, what I want to talk about first is just to kind of go over these headings here. So we're looking at the ticker, we're looking at the company, we're looking at if the company has a moat, meaning does it have a moat around it, economic moat around it. That means does it have a competitive advantage over their own competitors, if you like. We look at the EPS, or earnings per share. We're looking at price to earnings as well. We're also looking price to earnings to growth, a PEG ratio. So what is a PEG ratio? PEG ratio is generally a better indicator of a buy. In particular, a PEG ratio under 1, suggests is that the stock price is not currently basically accounting for expected earnings growth. The PEG ratio is a slightly better version of the PE. The reason I said that is because basically it informs us, how cheap stock is relative to its growth rate. Because normal PE is just tells us based on historic information, unless you look in the forward PE, right? But that still doesn't take into consideration the expected earnings growth. Now, one of the problems with this as well is how can you predict the growth, basically the earnings growth? Again, sometimes that information might not be available to you. Sometimes the companies can lie about this. Sometimes things can change. The microeconomies might change, and so on. But for the companies that we're looking at, we will look at the PEG ratio to see if they are also, because they are all growth companies, to see how expensive they are in relation to their earnings growth, expected earnings growth, right? We'll also look at the sales price to sales as well. Ratio which is a valuation ratio that compares a company's stock price to its revenue. And again, that's a very good one to look at. And what happens, a good one will falls between 1 and 2. So between 1 and 2 is good. Anything that's less than 1 is also better. And finally, what we look at is return on equity. Return on equity is used when comparing the financial performance of companies within the same industry. So we're looking at technology companies today, and if you want to compare them, this return on equity will be one of the ratios to look at. It's a measure of the ability of the management to generate income from the equity available to them. A return between 15 to 20 is considered good. Normally, I look for 15 or more, and that's it. Right, so let's have a look at that. Now we know exactly what we're looking for. With the rest of them is a current ratio. Current ratio basically tells us how if the company is able to pay off their current liabilities in the next 12 months. Okay, free cash flow, we talked about that before. Total return in the last 10 years. Some of these companies have not been around for 10 years, so we'll look at 3 years, 5 years, whatever it is. Growth estimates the next 5 years is really important, especially they are growth companies. Valuation from Morningstar, and then we'll look at the price, the fair price of these companies as well. The first company we're looking at is Adobe. Adobe has a wide economic moat. It has the EPS, positive EPS, and it has a PE of 28 right now. But it has a PEG ratio above just 1, so it's not bad at all. Price to sales, it has 8.28, so that tells us probably based on price to sales it might be overvalued at the moment, but based on the growth side of it, it seems fine at the moment. Return on equity almost to 24%, current ratio above 1, and price, so we're looking for anything above 1 for current ratio is good. That means they can cover their debt in the next 12 months or liabilities. Free cash flow here, we're looking about 6.8 and total return of 25 almost in the last 10 years. Growth estimates the next 5 years, we're looking about 14 and 33% discounted. 400 and basically 50 is right now the price they're expecting. I think it was about 280, 290 yesterday. I think that's where the price was. The next company we're looking at is Salesforce. Salesforce is another company that I own in my portfolio. It has wide economic moat. It has a positive and EPS, and it has a price to earnings of 280. So just based on that, you'll think it's very expensive, but based on the price to earnings to growth, you basically is below between 1 and 2, so that can tells us possibly based on the growth expectation this company is not as expensive. Price to sales 5.22, that's absolutely fine. Again, is we're looking for between 1 and 2, so it's not as expensive as you would think by just looking at PE. Okay, and then profit margin we look at 1.80. So again, this company has been around for a while now, and they are still in the growth phase. That's probably why the profit margins return on equity is almost non-existent, but they do have current ratio above 1, which is fine. So that means they are okay for the next 12 months, and they have $5.6 billion of free cash flow right now. 15% total return of the last 10 years, which is really good, and growth estimates about 15%. Now some of you might think, okay, total return of just 15% for taking a huge risk at a company like this might not be worth it, and you might be right. Okay, normally I would have actually said at least 30% or more for these type of companies, because look at the PE is very risky, right? But price to sales and the PEG ratio tells us basically it's not as expensive as basically the PE suggests here. But again, because the earnings basically is almost non-existent, the EPS here, okay? But the company is expected to grow at 15% every single year in the next 5 years, and 36% discounted right now, and $240 per share is basically where the price should be. Okay, the next company is CrowdStrike. This company is in the security side of things, and they have a negative EPS, therefore there's no PE, but price to growth, okay, price to earnings to growth, and we can estimate that because obviously we're looking at the growth side of things. Okay, it's about 3 right now, 3.62. So price to sales is about 22. Obviously there's no profit margin here, and there's no return on equity, but they do have enough to cover their current liabilities, and free cash flow of 542 million, and total return of 36.52% in the last 3 years, and growth estimates in the next 5 years they're expecting about 74. And I'm not surprised. This company, I think even if it's not 74% growth every single year, it will definitely grow at least 50% or more. You just have to look at the companies they work with and the companies they protect, and you can see that those companies are growing. They work with a lot of the Forbes 100 listed companies, so just have a look at their financials if you're really interested. Great company. I used to own it. I sold it a long time ago, and since then it's actually down almost to 30-40%, so it was a good timing for me to get out, but ideally I would like to own this company again at some point. Fair valued at the moment, we're looking at about $196 per share. That's the expected price in the next, basically that's intrinsically where it should be. The next company we're looking at is the Fortinet. This company is in telecommunication solutions. It has a wide economic moat. It has a positive EPS. It has a quite high PE, almost to 60, and price to sales to growth or PEG ratio, price to earnings to growth or PEG ratio, for example, is just 2. So that tells me it's not that expensive based on this, okay, on its own. But price to sales says but just a little bit too expensive. I'll be honest with you, when I look at price to sales, I normally look about 15 is the maximum price to sales. Anything below 15 I normally go for. But in this situation, this company is actually trading higher PE, but price PEG ratio and price to sales are quite low in comparison to the PE. Profit margins, we're looking at about 17.7, return on equity 156, and current ratio just above 1, and they have $1.1 billion in the bank. And total return in the last 10 years, we're looking at about almost 15%, and we're looking at growth estimates in the next 5 years about 23, almost 23.5% right now, every single year in the next 5 years, which is huge if you think about it. And then when you look at Morningstar valuation, we're looking at about 27% discounted right now. $68 per share is basically where that price should be. The next company is Palo Alto Networks. This company is in the security side of things, so these companies are kind of competitors in a way. It has wide economic moat. It still has a basically negative EPS, and there's no PE right now, but it has 1.87 PEG ratio. That tells me, remember, we're looking for between 1 and 2. We said on the other hand, basically anything basically below 1 is actually good, anything above 1, so it's not that bad, okay. Price to sales, we're looking about 9.35, and profit margin obviously doesn't exist. Return on equity doesn't exist yet. Current ratio just below 1, so that tells me maybe the company might struggle, but they have 1 point to pay off that debt if the current liabilities, but they have $1.79 billion, so they're not going to run to the bank, because the risk with these companies is, because they're high growth, they need money, they need cash a lot of these times, and because interest rates are going up a lot, this is not basically ideally the companies that you want to invest in if they don't have enough cash. But this company has almost $1.8 billion in of cash if they needed to, that they can potentially use to basically acquire, just grow the business if you like, okay. Because the danger is, if they go to the bank and get a basically I don't know, 3% 4% rate on a loan, that's going to cost them a lot of money, and you don't want that. Total returns of the last 10 years, we're looking at about 23%, and then growth estimates of the next 5 years, 26%, fairly valued at the moment. $197 per share is where the price is right now. Next one is ServiceNow, very similar to Salesforce. It has a wide economic moat, it has a positive earnings, it has a PE of 427. But it has a PEG ratio of 1.53, it has a price to sales of 13, it has a profit margin of 2.8, return on equity 4.8. And like I said, again, because they are very similar, these two companies, they're still in that growth phase, but they do have a current ratio of 1.1 and $2 billion in the bank. Total return of 26% in the last 10 years, and growth estimates in the next 5 years, we're expecting about 27%, 41% discount right now. The price should be $675 per share. There you have it. There's 6 different companies that this guy owns in his portfolio, and there's a reason why he owns it, because look at the growth of the expectation. I mean, Adobe is not a fast growing company, but if they acquire this company Figma, I'm sure that will accelerate their growth in the next few years, okay. And that means they actually taking a competitor out of their way. The only one that they still need either to acquire or compete with will be Canva, okay. So, but the rest of these companies are still in their growth stage, and they are great companies. But obviously, like I said, if these companies do not have a lot of free cash flow and they're not going to grow their business organically, you're going to have to worry about these companies getting into debt, because obviously they will need to go to the bank and get some money, and that money will cost them a lot because interest rates are very high. When interest rates were 0 in 2020, these companies were booming. Why? Because they can go to the bank and get money for free, and they can reinvest in that, in the business and so on. And I'm sure that's what they've done. Okay, but now basically the interest rates are going up again. they will not touch that money. I hope they wouldn't. But these companies, some of them have a great free cash flow, some of them don't. So you have to think about, this is not the type of companies that you want to own in this kind of environment, unless they have a really good free cash flow and the growth estimates is very high in the next few years, and they have a product that is basically in demand. That's the most important thing, because I can't see any companies cutting down when it comes to security side of things. They need protection, right? So these companies do need their protection. I can't see any companies stopping using Salesforce products, because they need to maintain that. They need to make sure their customers are happy. They need to make sure their cloud data is up there, up to date, analyzed, and all of that stuff. Same goes for service, service now, and so on. So all of these companies have a moat, especially the other 5 here, apart from wide moat, apart from CrowdStrike. Anyway, I hope you enjoyed the video. If you have, please give the videos a like, subscribe to the channel. Let me know if you have any questions. Assalamu Alaikum.